All right. Hello and welcome. Good afternoon. I am Colleen Kern, a director with Tax Time CPAs. Today we are hosting Business Espresso, your jolt of business acumen. Our hosts have extensive backgrounds in their respective fields of sales and marketing, accounting, wealth management, and law. Their backgrounds all come together to help small business owners thrive. Today, our expert comes from our panel. Mike is going to inform us about an underutilized tax savings approach. Every other week, you can find us here on Zoom at 1 p.m. Mountain Time, where we offer you a different topic presented by an expert to help you create, build, and optimize your business. Each presentation gives you at least one actionable step to walk away with, making you better at running your business, not being run by your business. Make sure you like and subscribe our YouTube channel to catch tips from all of our experts and be the first to know about our new content starting in September. Before I introduce today's hosts, a little reminder, we try to make this as interactive as possible. If you have questions, please pop them in the Q&A box or in the chat. Don't keep them to yourself. We try to answer those questions live, and after our presentation, we do open it up to your questions, and we'll try and get those answered for you then as well. Without further ado, our hosts today, we're joined on our panel by John Gies, our business and growth strategist from RAS Squared, our expert in scaling your sales and marketing. Christina Gilbertson, owner of Gilbertson Law Office. She uses her business law expertise to help small businesses protect themselves. And Sam Saeed, an award-winning financial advisor with Northwestern Mutual to help guide us in risk mitigation and wealth management. Finally, our presenter today, our very own Mike Hurdle, founding member of Tax Time CPAs. Mike has built his tax strategy firm to meet his clients where they are. No excessive jargon or stuffy business suits here. The firm is built on subscriptions to help encourage proactive communication so you don't wait until tax time to ask and get your questions answered. With over 20 years of experience, Mike's knowledge covers everything from corporate to nonprofit, accounting, and tax. And Mike's passion is taking his wealth of knowledge and converting it into effective tax strategy for his clients. Mike, I can't wait to hear from you today. Take it away.
Hey, this is Mike Hurdle with Tax Time CPAs, and we are going to kind of dive into deducting medical expenses. And one of the new things that came out of the new tax law are understanding health reimbursement arrangements. Now, these are different than health savings accounts. They're different than, cafeteria section 125 plans. So they're a little different. But one of the big things that we want to be able to do is a lot of us, when we have medical expenses, in the IRS code, there's a 7.5% floor, which means the first 7.5% of basically your income is not deductible. And then above that, it becomes deductible, but only if you itemize. So the next thing we want to go to is the next slide, which is what is a health reimbursement arrangement? So a health reimbursement arrangement is an IRS-approved employer-funded health benefit used to reimburse employees for out-of-pocket medical expenses and health insurance premiums. Now, there's three types of those. There's the qualified small employer, there's the individual coverage, and then there's the group coverage. Now, each of these are a little different, and they're a little bit different to set up. But the real thing here is it's not health insurance. This is not to replace your health insurance. It's a methodology where the company can reimburse employees directly for their medical expenses. Now, that can be used to reimburse medical insurance premiums that they pay. It can be used to reimburse just regular medical expenses that occur throughout the year. So let's talk about, what is a qualified small employer HRA? So kind of for short, it's a QSEHRA, acronyms. We're big in accounting. We have tons of acronyms. This is really available to employers that already have a qualified health employment plan. So you set these up similar to like a 401k. They're administered, they're a plan, they have to have administration costs, but really with a qualified small employer HRA, you can offer allowances of up to $5,250 for single employees or $10,600 for employees with a family. Now, the trick here is that all employees must receive the same allowance. Now, there's except some cases regarding a family status, but in essence, what this is you already have a qualified health insurance plan, and this is a way that you can reimburse additional expenses on top of that. So what is an individual coverage? So an individual coverage is similar to the qualified plan, but each employee, rather than having employer-sponsored health insurance, each employee is out there in the market and has their own insurance coverage. So with this, it's available to employers of all sizes and functions. Many employers choose to offer this type of plan because it looks and feels like a group health plan. And there's a few key differences. One, there's no allowance on caps. So if you want to set it up, and again, this is really more powerful when you're a small member, single member LLC, and you're the only employee. So if you want to set that cap at $20,000 or no cap, that's a way that we can start to move to get these expenses reimbursed for regular occurring things that, in essence, most of the other times may not be deductible. Now, it's only available to employees covered by their own insurance. And finally, this plan offers a complete budgetary control. So if you're a small business owner, you're like, well, I want to offer health insurance. I want to be able to help my employees and give them good benefits, but I really don't know what the budget cost is. I don't know if it's going to go up. I don't really know if I'm going to get extra fees that get associated. This plan allows you to set that limit to say, I'm going to reimburse up to $10,000 per year per employee, or $20,000 or $5,000. Whatever is in your budget, you get to set that at the beginning, and then they get to offer it. The other thing that's important to understand is it's a reimbursement. What does that mean? It doesn't mean that you just drop money into their account like a health savings account that is funded by the employee into their own account and then they spend the money. A health reimbursement arrangement is specifically designed that they go out and spend the money and they submit receipts. They submit receipts to the company and the company reimburses for those expenses. So there is some kind of regulatory hoops and things to jump through, but that is similar to a 401k. You have those regulatory issues that you have to be in compliance with, and tracking receipts and making sure that you're reimbursing it. So what is the group coverage HRA? This is the one that's available for group coverage. So these are for employees that already have group health insurance. So only employees covered by your organization in your existing group policy qualify for the HRA. So if your company already has health insurance as part of their plan, if somebody doesn't participate in health insurance, then they can't participate in this either, right? It helps employees pay for out-of-pocket medical expenses like deductibles, co-pays, medical expenses. So again, it's a broader scope. It's a broader scope of what you can reimburse to your employees. And why is that important? Well, let's kind of go to the next slide and we'll talk about savings on taxes. So we've talked about this in a previous presentation that we've done, right? So who wants to save $10,000 on their taxes? Yeah, all of us raise our hand. We're like, oh, we all want to do that. Well, is it wise to spend $30,000 to just save $10,000? No, because you just spent $30,000 to save 10, you're still out net $20,000. So the real main focus of effective tax strategy is to try to identify those expenses that you're already doing that may not be deductible and associate those with a business purpose or some other way to get them deductible. So for example, one of the ones we talked about before is the difference between charity and marketing, right? If I donate to charity, there's limits on that. I have to itemize my deductions. However, if I advertise with the charity, I still give them the same amount of money, but I now have transitioned that to a business deduction that's 100% deductible. Same thing here, right? Currently, medical expenses, like we talked about, have that 7.5% floor, which means the first, if you're at $100,000 of income, that first $7,500 you spend on medical expenses is not deductible. And then they're only deductible if you itemize. However, with this strategy, you're reimbursing those expenses to the employee, and those are 100% deductible for every expense to your business right out of the gate. So again, if you're a small business owner, 1 or 2 employees, preferably 1, you can, in essence, get all of your medical expenses for the year, your premiums, your deductibles, your co-pays, everything along that line to be 100% deductible and effectively bypass the floor that is established in the itemized deductions. So let's take a look at a quick example. So this is just a kind of a simple example, and we're just going to kind of go through a couple scenarios so you start to get the feel of where the power of this deduction comes into play. And this is a new deduction strategy that came out of the Trump tax cuts passed a few years ago. So if we assume, hey, we've got a healthy individual, making $125,000 a year, that medical floor is already set at almost $9,400. So the first $9,400 that he spends on medicals or she spends on medical are not going to be deductible. Let's say they're a pretty healthy individual. They only have like $75 a month, co-pays, you go in to get their teeth cleaned, whatever those dynamics are. Well, they're going to spend $900 a year in medical expenses. Maybe their health insurance costs them $550. So they spend about $7,500 over the course of the year. Well, all of that is not deductible because it's under the floor. But if we use the health reimbursement right out of the gate, the tax savings, if you're in the 25% tax bracket, is going to be $1,875 for just implementing this plan. Okay. So that's a pretty much healthy individual. That's really where it goes. But now let's kind of take a look at, say, same individual that all of a sudden tears up their knee on the ski slope, or, happens to get sick with the flu, COVID, whatever, and they have to go into the hospital. And we all know that even if you have health insurance, those deductibles rack up, and the bills they come in that you think are covered, all of a sudden they're not covered, or they're only covered by 20%. So let's just say, as an example, the same individual now has $9,000 a year in medical bills, which isn't a stretch if something happens to you. So now all of a sudden that individual, we have two columns, one if they itemize, one if they take the standard deduction, but we'll look at the itemized one just to kind of keep it on that level. Well, if he had $9,000 and he had his health insurance, he would have expended over $15,000 in medical expenses for the year. The deductible portion, since that floor is there, is only $6,200, right? So the lost tax savings that individual has is $2,300 per year. If we factor that over 10 years, that's a savings of $23,000 that this strategy can help put back in your pocket, right? It's money you're already spending that you're just giving to the government. This is a way to keep it in your pocket, okay? So let's jump over to the next one. Now this is a family. So now we're going to kind of look at a family and say, okay, what if we've got a healthy family? Right? Family of four, each, $250,000 of income, not too much of a stretch, a couple of kids, and $150 a month is probably pretty low if you've got a couple of kids, sniffles, that kind of thing. Your health insurance about $1,200 a month. Okay, that's probably in the ballpark. Right out of the gate, you're already spending over $16,000 a year, and that medical floor, based on that income, is sitting at almost $19,000. So you lose all of that. That $16,000 is not deductible at all. And you're going to lose almost $5,000 of actual tax savings, cash, extra taxes that you're going to have to pay, right? So that's the big one. And it doesn't really matter between itemized and standard because it's under the standard deduction. So the next one, let's say somebody in the family gets sick. You've got 2 kids, 3 kids, new pregnancy comes along, those medical bills can rack up pretty quick. So if we take this idea that, hey, with a family of 4, you've got about $15,000 of medical expenses, you've got health insurance of another $15,000, hey, you're spending about $30,000 a year in medical expenses, and your deductible portion on the itemized side is only $10,650. So in other words, you almost have $19,000 there that you're not getting a deduction for, and that at a 30% tax bracket, now all of a sudden you're in that $5,600 per year of extra taxes that you're paying that you don't have to pay by just implementing this strategy. So that over a 10-year savings, that's $56,000 that you would have available to do something else with. And that's really the key. It's when we talk about tax savings and tax strategies, we also want to look at the long term. We say, all right, yeah, that's great that you saved money on taxes, but what are you doing with it? Are you going out and buying the new Ford F-150 and just after 10 years, you've got nothing to show for it except a depreciated truck that you've got to buy another one? Or do we take it to another level and leverage that tax savings into something more powerful? And this is where we really try and work with financial planners like Sam Saeed, who's on the call today and does fantastic work. But this is an example. If I took that $5,600, turned it over to a financial planner and said, hey, this is tax money that I was going to pay to the government anyways. I use this tax strategy. I saved it. I pump it in here, and he's able to get me just a simple 8% return on average year over year. At the end of 10 years, that $56,000 you saved multiplies into $25,000 of additional earnings. So you actually sit there with $81,000 in your bank account. Now, if you keep doing that for another 10 years, and here's where that compound interest really starts to take over. Now, all of a sudden, the next 10 years, I have a total of $144,000 that I've earned on this money that I was going to give to the government anyways, that I just kept. And now I'm sitting with $250,000 in the bank. All right. So the last one, we're going to say, hey, okay, yeah, that's fine. You're estimating these kids are going to get sick all the time. The last one, it says, hey, let's just go back and use the healthy one. Yeah, you only have $150 a month with your health insurance. Now, all of a sudden, you're saving $21,000, $125,000 over 10 years, $222,000 in your bank account for money you were going to give the IRS anyways. Set up the tax strategy, put it in your pocket, invest it, leverage it for the long term. So I hope this kind of gives everyone an idea of how tax saving strategies really can add value, but they really add value if you pair them up with other people in this group and really leverage it to achieve more for the long term, right? We always want to be strategic and disciplined in our long-term planning, and this really puts it there. Again, how many of us would like to have an extra $22,000 sitting in the bank account for money we were going to give to the government anyways? Well, I'll take that money back and set it in my side. I don't want to have to rely on Social Security. And this is just one tax saving strategy. We can pair these up with other ones and we really start to build some wealth. So that's health reimbursement arrangements in a nutshell. They're powerful if you use them right. And, if you have any questions or say, hey, how does this fit in with me? How does this fit in with my business? Please reach out to us, contact us, and let's sit down and do a quick discovery call, and we'll figure out what's the right fit for you.
If you have any questions, please pop them in the chat. We would love to have those live. Mike, this is obviously a very powerful tax strategy, but what is the cost to even put one of these in place?
Well, it's similar to a cost of having a 401k. So, if you go out and establish a 401k with a plan, there's an initial setup cost. You might be looking at, $300, $400 to get it set up. And then it's a per employee per month type of management thing. And these companies will file all of the returns for you, like the 5,500 that you have for a 401k. There's still reports that you have to file for your health reimbursement arrangement. So they take care of that. But you're really talking about, probably maybe at the most $1,000 a year, probably around $750 a year to really maximize this strategy on your own. Again, if you want to come over, we have planned that we incorporate these into, along with bookkeeping, tax planning strategy, and we do other tax saving strategies as well.
And of course, that would also be deductible as a business expense. That
is correct. Yeah. And one of the other things that you really want to do is, think about pairing that up. Like, for example, I save $5,600, or let's say it's $5,000 a year from this tax savings. Now I go over to Sam and I say, Sam, hey, I've got this extra money. Can you set me up with a SEP IRA or something additional there that's tax deferred out of the gate as well? So not only do I save the tax rate on the medical side, I also get to deduct that off of my income and save that same 30% again. So I get to double dip 2 times through the process.
Right. Very, very interesting. Thoughts from our panel? Yeah.
Obviously, there's been different regimes on with the Obama, Trump, and now Biden administration. What if Congress passes new tax law and increases the tax rates? Then what?
Well, the tax rate becomes even. Again, we all know the tax rates are going to go up. The government has spent so much money and stimulus money going out the door, regardless of Republican or Democrat, tax rates have to go up to pay it back. But the power of the saving even becomes more dynamic because the tax savings go up. In other words, if I'm in the 25% tax bracket, hey, I've got $4,000. But if I'm in a 35% tax bracket or a 40% tax bracket, now all of a sudden the power of each savings dollar is magnified by the increase in tax rates.
Absolutely.
So, Mike, I'm curious, if I'm a small business owner, how much time does this take to set up?
Same amount of time it takes to set up a 401k. So you're talking probably an hour of kind of sitting with us, getting all the documentation together, filling out the paperwork with the plan. It's really straightforward and simple. It's one of those kind of things that as small business owners, it might not be in our wheelhouse of things we like to do, filling out paperwork, but that's really what Tax Time is here for. We have plans that we incorporate that in there to make it seamless for you. So give us the documentation. We'll help you get it all set up. We'll help management throughout the process.
So I heard, maybe an hour out of my schedule in 30 days total to have something put in place.
Correct. And then the management side is you have to make sure that, you're collecting the receipts and making sure you've got them documented, because that's how the process works. You can't kind of pre-fund the account. So all of us as small business owners, we tend to cut corners because we're busy. You can blow the plan coverage if you say, oh, I went and I spent that $300 at the doctor the other day. I'm just going to send it out of my account without having the receipt first. So little kind of regulatory things that we want to do, but the power for the savings is worth the time. And again, we can set it up so that you're sending your receipts to us. We're managing that. Again, minimal fees, but for maximum tax benefit dollars.
Thank you.
Absolutely. Christina?
Yeah, so here we are in August already somehow. If we were to set this up now, can we apply it to things we've already paid earlier in the year, or is it only like we set it up August 3rd? It's any charges that we have August 3rd forward.
The great thing about that is it's quasi-retroactive, right? It's based on receipts and being reimbursed. So I can accumulate receipts all year long and then submit them to be reimbursed from the plan. Right. So getting it set up now, we can still maximize this for 2021. And you don't have to reimburse once it's set up. You don't have to reimburse monthly. You can wait to the end of the year. Here are all my receipts. Let me get a big deduction. Let me get my big reimbursement check. Or you can do it every quarter or every month. But it is still available to implement and say, yeah, I'd like to set up the health reimbursement arrangement. And then I can submit the receipts for the principals I've paid on insurance, any deductibles, any co-pays, anything along those lines. Just you have to submit the receipts.
Definitely a powerful tool. What about for people whose health insurance is paid through their spouse's job?
Now, this gets a little tricky. Again, we talked about those 3 different types of plans, right? So it depends on which one you have, and we have to kind of do that exploratory call. But in essence, those can be reimbursed by your employer. So if I am an employee of the company and my spouse has health insurance coverage outside of it, and she is paying, it's only going to be for what she pays. So if the company pays 90% of it and she only pays 10%, then I can only reimburse her for the 10% actual out of pocket. But that can be reimbursed as well, as long as you're covered on that health insurance. Again, if you're not covered, then you can't.
Got it. Makes sense. Definitely powerful stuff. I don't see any questions from our attendees. Sorry, a little blip there. So I'm going to kind of wrap us up. Any final thoughts from our panelists here?
Why would someone not want to do this? I mean, this seems to make so much sense. Why would someone hesitate?
I'm almost going to put that off to Sam. Why doesn't someone buy life insurance? Right? It's just the unknown. It's one of those kind of questions. It's like, hey, this sounds too good to be true. I don't have time. I just want to go make money. I just want to go sell. And that's really where tax time comes into play, is to say, we totally get that. You're a business owner. You're stressed out. You've got other things on your plate. Hand it over to us and let us do the regulatory side. That's what we're good at. So we can manage that for you. And then you're getting the best of both worlds. But from a cash flow perspective, people do things silly all the time.
It's worthwhile mentioning, Mike. This is obviously a subject that a lot of people wouldn't necessarily know about. No one wakes up thinking about this type of tax saving. It's a very specific thing. If people obviously use you as a CPA, would you obviously bring up other things, other tax savings that they would never have thought of?
Yeah, that's right. And that's really the power behind it, is we're not just looking at implementing one strategy and just kind of walking away. We want to be able to say, hey, do do you have medical expenses that this benefits you from? Almost everyone does now. So yeah, let's do that. How do we also put in the SEP 401k, the SEP IRA? How do we get you investing long term? How do we protect your business by using Christina and good HR materials so that we're protecting you from a legal standpoint? We want to be holistic in everything we're looking at. And again, you've got qualified business income deductions, you've got meal deductions. We want to be kind of that business partner with you, not just a tax preparer that prepares your tax return, but really being proactive throughout the year and bringing in our partners like yourselves that we partner with that also add value to your small business and help you save money and help you grow your business effectively and safely.
I'm sure you sold a lot of new parents on the childbirth piece. It's crazy.
Yeah. Yeah, regardless of how much health insurance you have, there's always seems to be a bill that shows up.
Just keeps them coming. You pay one, another one comes. Just stop. I'll pay them all now. Just stop.
Then you get the college tuition bill, and you're just like, "What? What happened?"
Never done. So, and one of the biggest things with tax strategy that I can piggyback that it's you really what you don't know, you don't know. So being able to work with someone like Tax Time is, helping you find out what you don't know. So thank you, Mike. Your presentation was awesome, so informative. I learned things too. So fantastic. So thank you everyone for joining us. If you have questions afterwards, please feel free to pop them into the Facebook group. It is over there in the chat, or schedule a discovery call with Tax Time. Our Calendly link is there as well. Our next session, August 17th, will feature Christina, and she is going to share with us the changes to PTO and equal pay that affects all employers, not just the big ones, followed by Sam on August 31st. These will be our last two presentations in this format, and then we're going to kind of switch it up to bring you some more value by bringing you true espresso shots of knowledge starting in September, Monday through Thursday via our YouTube channel and Facebook. So make sure you like and subscribe. Thank you so much for joining us today, and we will see you next time.